What's up, Outliers? Happy Friday. Today stream, we're going to talk about a concept that actually caught my attention yesterday. We were doing a skill development segment, reading through a book together, just talking about some of the options trading concepts from in there. And there was a specific line that caught my attention, not because it directly talked about this, but it loosely referenced a peripheral topic that made me think of this. So there's a really common misconception when it comes to the way retail traders fit into the market. The goal for the stream today is actually to talk about that. And more specifically, to first debunk a broken phrase used. And then second, as per usual, to pivot that to something more applicable and something that hopefully you as traders can integrate into your approach and into your process. Now, before I get into that, I want to tell you a story from the gym recently. And this is a little bit of a reminder on where most people sit with this stuff and how important it is to try and just generally share basics with people. So I was at the gym. There's a dude that I bump into every once in a while, and he is loosely interested in the markets, more standard and kind of like, here's a stock that sounds cool and we'll trade it a little bit and stuff like that. Okay. So I say hi to him, and then I'm working out. I'm doing lying hamstring curls, in case you're wondering. It's one of the few like good leg exercises I can still do dealing with the whole herniated disc thing. And he is standing at a machine next to me talking to some girl. I've seen her around, don't know her. And they kind of like bring me into the conversation, meaning I can see them talking, looking at me, but I had my earphones in. So I took my earphones out and I start chatting with them a little bit. Long story short, we get into the topic of finance. And she was mentioning how she is essentially like completely overwhelmed. She doesn't know what to do. And she has a couple accounts that she doesn't know what to do with them. And I literally said, oh, pull them up. Let's look at them. And she had a couple different IRAs. She didn't know really what an IRA was. She had a rollover IRA from when she left one of her prior jobs. You know, sometimes they'll roll over the IRA for you so that it's in your name at that point from a 401k or, you know, whatever their structure is. And then I'm looking through it, and she has not a ton of money in there. She's probably doing as best as she can when it comes to savings, but that was one of the first things that struck me. I don't know how old she was. I would guess in like her mid-20s maybe. But seeing what was in there, I was like, yeah, I mean, compared to most Americans, she's actually doing well. But compared to, I think, what most people in our community are trying to do, it's not even close. And that right there was the first really good reminder for me. Just a general gauge of like where most people are with this stuff. Why does that matter? Well, it's because in all of your conversations with most people, that's their understanding, and the decisions that are leading to that being what it is are also decisions that permeate the rest of their life, which is something to think about. So I literally say, like, if you want, I can literally show you how to set this up so that it's at least doing something for you. Because after poking through on her phone with her, you know, sitting right there, but I was poking through on her phone, and between her accounts, she's like mostly in cash. It's like cash and then one like target date fund. So first thing, I absolutely hate target date funds. And I told her that, but I also said I wouldn't get out of it because then it starts creating transactions. I would just at some point, if you want to take a look at what's in there, it's worth it. But right now it's something and it's doing something, which is fine. The main stuff that needed to get fixed in there were the overwhelming majority of the portfolio that's just sitting in cash. So all I did was explain to her what IRAs were. She didn't know. I explained what ETFs are. She didn't know. And then I explained the process of actually putting the money to work to do what she wants, specifically in an IRA, which you manage it, right? Like you're the one that has to click the buttons. You can like reinvest dividends and stuff, but there isn't a bunch of like automatic setups like you get typically with 401ks. So I just funnel her these different accounts into VOO. Just put it into VOO, leave it there. 20 years, it'll be better than what it is now. But that entire experience was such a profound reminder of how a lot of the things that you and I probably take for granted, the ideas of like understanding what a 401k is, understanding what an IRA is, understanding the concepts of compounding return, understanding how timeline sensitive that stuff is. A lot of people don't. And they're not bad people. They're literally just not educated. They just don't fucking know. So the whole point of like this entire story is by me taking that 10 minutes to walk her through how to do these things in her portfolio, think of these two different scenarios over the next 20 years. Scenario one, where the money is just sitting in cash. Scenario two, where it's in an index ETF, likely to appreciate over that time frame. Really big differences. So the message here is try where you can to share that with people. You don't have to get into the world of derivatives trading. The majority of people not going to get there, and that's okay. But I do think it's so important for people that have this knowledge, that have this skill, to freely and regularly share it with people. Try and help someone. It's not going in and giving financial advice and saying, get this stock, get rid of that stock. It's the absolute basics of trying to help break down that barrier, because as we were talking, she said something that I completely understood. And she was just like, I don't know what any of this means. And it's like, yeah, dog, same. Like, this is all bullshit. It's all just fucking words that you have to learn. But a lot of people don't know it. So that is my public service announcement for today, to just spur that thought, right? Like as you're having conversations with friends, family, just people, if the topic of finance comes up, I personally think it's always completely reasonable to be like, hey, do you have like your retirement account set up? Like, do you feel good with your investments? And again, it's not like some business pitch to get them down some investment advice path, but a lot of people, they don't even know what those things are. And then they get super overwhelmed when they see them because they don't want to fuck it up because they've worked really hard for that money. So those kind of like really, really, really small things can make huge impacts for people. Okay, that's the soapbox for today. That is hopefully something, though, that you will consider, and where applicable, find ways to integrate that and to help some other people, because a lot of people need help with stuff like that. Okay, so let's talk about this thing that we were reading last night. So we're reading this book last night, and one of the terms in there was just talking about the different rationales that retail traders, especially derivatives traders, often have. And there's one really common rationale that I think is highly, highly destructive. And that's what I want to talk about. And then after that, I want to, again, talk about how can we pivot this to being something smarter. ZX Borg says, I can relate. I was in that girl's shoes until I was close to 50. Despite a degree in engineering, I knew shit about money. Yep, that's exactly right. And that's the irony of it all, is like there really is nothing that magical or special about any of it other than the fact of just knowing it. That's the crazy part, right? Like just being good. And the funniest part is like she actually had some really good intuition, because at one point she was, when I was putting her in VOO, so just a low cost S&P fund. And she was asking, she was just like, is this one of those things that's gonna, lose all my money? And I was just like, no, not necessarily. I mean, there's risk. Technically, that could happen, but if that does happen, you're not going to be worried about money anymore. So it's going to be about food and water and bullets at that point. So yeah, if that happens, you got other shit going on. But, and then I gave her context. I was just like, for example, during the most recent big drawdown, there was a bear market in the last 5 years that was about 19% down on the year. And then, during COVID, there's, depending on where you choose to measure the drawdown, 20, 30% drawdown. So I was like, that's really the way to like mentally frame it. The money that's in here, it might look down 30% at some point. And then she immediately interjects and she was just like, and that would be a good spot to buy, right? And I was just like, dog, you're fucking built for this. Fucking A, yes, that's exactly correct. So a lot of people, when they hear that their money might be down 30%, they're normally like terrified. But the irony is like her instinct was exactly correct. If you're an investor in something like that and it's down 30%, that is like load the boat, man. Get everything out there. So I'm pretty bullish on what she'll be able to like do with the account longer term, just in terms of like just making like decent decisions with basic knowledge. And the funny thing is like all we did was pull up her iPhone and then do a record screen so that she can literally follow how to submit an order. She now knows the difference between like market and limit orders. For her purposes, just a market order is completely fine. I told her, I was like, in the trading world, a market order is like the Antichrist. We don't click that button. But in your case, doesn't matter. So it's like just breaking stuff down like that. But yeah, I actually thought her instincts were quite good. So Reggie says public education system seems to skip teaching about finance. Yeah, I don't remember learning anything other than like balancing a checkbook, which was hilarious. But yeah, finance, credit, compound interest, basic retirement accounts, it really isn't in there. And I'm not one of those people that think it's because the system is like trying to fuck people. I really don't think that. But my guess is that there's probably a ton of regulatory tape to get that kind of stuff in there in a way that's broadly approved. To get curriculum adapted is very, very difficult. But yeah, it should be in there. Like the basics of finance should be in there. It shouldn't be a thing that you need to take on as a personal side quest to go figure out. Because again, like if you're anything like me, it literally wasn't until I came across that teacher in high school that I learned any of this stuff. And it was just through complete happenstance of him seeing that I was working and then saying like, what are you doing with your money? If he had not made that interaction, I still wouldn't have known for who knows how long, probably until the Marine Corps. Because the Marine Corps does talk a little bit about retirement, which is good because they do talk about stuff like at the time, the TSP. So yeah, that stuff was decent. Okay. Enough basics. Let's talk a little more technical. So if we go through and we poke around a place like Theta Gang, the reason why I come to Theta Gang is because a lot of people in Theta Gang have this mentality that they're smart, that they're smarter than the average trader and these kinds of things. So you can see, right? We are selling options to Wall Street bets degenerates using Theta Gang strategies, right? So like the entire starting point for what their community is built on here is kind of like shitting on another community, which I have to be honest, I'm never super down with that, but I do understand it and it's not wrong. Like it isn't wrong. The funny thing is, depending on the stuff that they're trading, it's not necessarily highly accurate, and we'll explore a little bit why. Malik says, should I pull out all of my funds from a TSP and put into an investing account? I mean, the thing with stuff like that is you have to be really, really thoughtful in terms of, oh, you're saying that it's a joke, because I actually moved my funds out of a TSP into a tradable account. So like I actually did that. But the main thing I was going to say is when you're doing stuff like that, you do have to be thoughtful about what the accounts are. So if you have a traditional or a trad TSP versus a Roth, you can roll it into an IRA, and that's completely fine. And as long as it's the like, so same IRA, traditional, Roth to Roth, you're good. And there's not a taxable event there. But it's actually exactly what I did, because again, at the time when I was in the Marine Corps on active duty, the TSP was only able to be invested in certain like target date funds, which again, I fucking hate. So I immediately wanted to do something different with it. So all I did was funnel it into an IRA. Now, one broader note while we're talking about account types like this is an important consideration to keep in mind for everybody is the difference between traditional and Roth IRA. It's something that a lot of people don't spend a lot of time thinking about until you realize you should have thought about it. The reason is it has everything to do with what your income picture might look like at different time frames, and then what tax treatment makes the most sense. Do you want to go in tax deferred and then pull out taxed? Or do you want to go in taxed and pull out tax deferred? And that really all has everything to do with what you think your income will look like in the future. Because for a lot of people, their income in the future is actually lower. But for people like us that are approaching finance quite differently, the overwhelming probability is that if you're doing this right, your income should be quite a bit greater. And that will be things through growing your account and even just getting standard yields, right? So think of it, if you get a 10% return on your $100,000 account versus that very same 10% return on a $10 million account further down the line, right? You're going to still trip different kind of tax treatment, same return, but over time, that amount of money has grown significantly, hopefully for you. So that's also worth your consideration sooner rather than later, because especially for more wealthy people that are trying to do everything you can to get your money into a Roth, there are different hoops that you have to go through. So for example, you can do like backdoor IRA contributions. And again, it's like dark pools. It sounds more nefarious than it is. It's completely legal. There's literally paperwork to do it. It's completely fine. But what you can do is make different kind of contributions to a traditional Roth, or I'm sorry, a traditional IRA, and then roll that traditional IRA into a Roth. And there's just kind of specific timing on how you do that to avoid different tax implications. And then again, there's different files that you have to form at the end of the year. But that's just another random odd and end that is absolutely worth thinking about though. Because again, that's the kind of thing that most people don't think about until they're starting to pull the money out and they're like, fuck, I wish I actually cared about this a little bit more like 20 years later, because when you're at that point, you're kind of stuck. So yeah. All right. So let's talk about this thing and this idea that a lot of short premium sellers on the retail trading side mistakenly have. The idea being that they are the house. And what this is obviously a nod to casinos, right? So let's just talk about this really fast for the pro members. This will be a little bit of a recap. So I am going to go quick. I don't think we need to belabor a lot of this because I imagine most people will follow along. But I do want to highlight a couple things really quick to level set. And then more importantly, I want to pivot to talking about how can we apply a different approach that's more applicable. So let's think about a casino. Okay. So you have a casino and they have a nice door And the idea is for people to come into this door to play games that have a house edge of varying degrees, entertainment primarily, and then walk out. So what happens at a casino that's so different than what you see compared to like these people? It's simple. The big difference between a casino and you as a retail trader is that as a retail trader, we have precisely no, absolutely none, zero structural benefits. None. You get no rebates, you get no special margining, you get no special access, you get no special latency breaks, nothing. So the way that casinos make their money is through processing many people and trying to get them to gamble as much as they possibly can due to the law of large numbers. They need the number, they need the frequency in order to get there. So the way to think about a casino is that as long as they have people coming in the door betting, and as long as they can keep them in there long enough, they will make their money, no matter what. It's a structural advantage that they have. Now, a big difference here is if we think about markets, you do not have a structural advantage. So you, as a retail trader, you have commissions. Whether you see them or not, they're there. You have friction, which is stuff like routing, spreads, bills, PFOF, all of these. So all of these make this much more difficult for you to transact quickly, and transact cheaply. A much better example of who is the house in a modern day market is either brokers or market makers. Either of those are completely great examples. The way that these operate so differently, that gives them a structural edge. For the broker side of things, the way that they make money is off of yields, banking operations, so standard margin loans and standard financing activities, just tailored a little bit more directly to investors and traders. And again, when I'm talking about brokers in this context, I'm talking more like retail oriented brokers. I'm not talking about like institutional quality brokers, slightly different. But these are just a couple of the ways that a broker will make money. Order flow, so payment for order flow is another one. Now, market makers, the way that they make money is through liquidity provision. And in that service of providing liquidity, they have a lot of benefits. They have better margining requirements. They have much better latency, meaning they can transact faster, and much lower overall friction and fees. It doesn't cost them anywhere near as much to transact. So if we think about the parallel between a casino and a market maker, the market maker, they make money by providing markets. What does a casino do? Provide a market. It provides liquidity. If I want to go in and play craps or pie gow or blackjack, I can't just go down the road and do that. It's not here. And there's also the legality of different things. So they're literally a liquidity provider. They provide you a space with amenities to go do these things technically in a legal way. The other thing to know about casinos, similar to market makers, is they have a ton of different exemptions. This is why they're able to structure games so that they don't need this big fat edge that would make it unreasonable for people to go play. Because if you go to a casino while you're there will be tons of people winning. And that's because of the economics of the system. They don't need these big fat edges because of the different kind of exemptions that they get from rebates, tax status, stuff like that. They're able to decrease what their total margin requirement is, meaning what their edge needs to be in order for it to make financial sense for them, so that they can find that sweet spot. How can I get as many people in here as I can to give them an opportunity to make money, but then also for me to harvest as much of that capital as I possibly can? This is it. And the reason why that economic is so important, in case you're wondering, is because there's really, like, if we think about heavy gamblers, they're at polar ends of the spectrum. You either have people that just have so much fucking money that they're just trying to fucking feel something, and they go bet with tons of money just to go feel something. Then you have the people that are the hopefuls. Those are the people that are hoping to win something and make it big, the lotto players. So they're appealing to both of those. But if we think of something in terms of volume, who are there going to be more of? Super duper rich people that also are interested in gambling, or poor people that are hopeful? It's the fucking poor people that are hopeful. Their margins on the super rich people will be quite good. That's also why you see super rich people get all of these different kinds of accommodations. They get suites comped, they get helicopter tours, they get shuttle service, and it's actually very cool. I've done some of that before, and it's literally quite fun. But they know at the size that you bet over time that still they're not necessarily going to make tons and tons of money based on also what they give you, but they're just looking to make that margin. But it's a volume thing when it comes to poor people, because poor person's going to come in with $100 and hope they can do something with it until you go somewhere that's anywhere on the strip. And then you realize, like, to play at one hand of craps, it's like $50 minimum bet, some shit like that. But that you can always go to the different casinos that are off the beaten path that are a little more reasonable for people like that. So, volume-based business. Market makers are doing quite the same thing. Quite the same thing. So, when it comes to the liquidity provision component, their job is just to get as many people in there as they can. And their job is to manage the risk on the liquidity that they're providing. Now, a lot of people sometimes think that market makers are also doing all this nefarious stuff to directionally speculate. And I'm not saying that doesn't happen. Some of it most likely does happen. But the majority of market making is really not that sexy. It is a function of making sure that your bids and offers are good, that you're managing your inventory well, and that's it. So the main thing that they're trying to do is just capture a bid-ask spread through liquidity provision. That's the house. So just because a retail trader sells options does not make them the house. You're not the house. You will never, ever, ever be the house. It's not your role. Now, a better example is insurance. The funny thing is, the insurance example still is not that great. Here's why. If we think of most insurance companies, the way that most insurance companies exist is by holding a basket of policies, tons and tons and tons and tons of policies. It's the same idea with a casino, the same concept of law of large numbers. Just as some of these people that come in here are going to win a bunch of money no matter what due to path, there are going to be a number of these people that need money in order to fix whatever they have insurance for. So this numbers element is super important. Keep that in the back of your mind. The other thing is the policy structure. And then sales. Because they have really, really, really good information. For those that don't know, a lot of times, especially in college during my grad, when I would do research, I was mostly using research that I could find through insurance companies. Why? It's because they have the absolute best information when it comes to the health prospects of different kinds of people, different demographics. Without a doubt, they have the best information when it comes to spending habits, when it comes to automobile accidents, when it comes to natural disasters. Why? Because their entire existence is predicated on their ability to price those events well. An easy example for this is tornadoes. I don't know if San Diego has ever gotten a tornado. If I wanted to get tornado insurance here, I'm sure that they would sell it to me. But it would not be super expensive at all. However, if I live in like Oklahoma, my guess is they probably get tons of them. If I lived in, it's just a guess. I actually don't know if Oklahoma gets a ton of them. So that might be a completely incorrect place. But let's just pretend that they do because I'm guessing they do. A place like Oklahoma that gets tons of tornadoes, you can get tornado insurance there. It's going to be fucking expensive. Why? Because the insurance company is pricing the probability of the event against the severity. That's why. I have a very wealthy friend that was looking to move to Florida. You don't know, a lot of rich people will go to Florida, and it's because state tax. You still don't get away from federal tax, but state tax. Now, there's a couple really nice places in Florida. I looked there myself, but the issue is it's super flat, and that is pretty not sweet. Same thing with humidity, super humid there. But let's say that my friend that was looking, they were looking on the West Coast in some of the nicer areas. In order for them to get flood insurance, because the probability of a hurricane is quite high, and they were looking at a quite nice house, their flood insurance, just to get flood insurance, not total insurance, flood insurance was over $100,000 on the house just to get flood insurance. This isn't to get other things. This isn't to get anything else that doesn't cover things like mold and mildew. It's just flood insurance. That's how much it was. Why? Because probability and severity. They price things very, very smartly. Now, what I'm getting at with this is three things that retail traders don't do to be good insurance companies. The idea as it applies, which is completely valid, by the way, the idea as it applies that a retail trader will sell premium in something, housing, inventorying, some risk that somebody else doesn't want. Completely factual. Earnings is a great example. Implied volatility skyrockets into earnings. Why? It's because everybody knows that there's a big event coming up and nobody knows how it's actually going to play out. So a lot of people are actively and willing to overpay to give that risk to someone else. The problem is a lot of retail traders are indiscriminate when they're trying to apply this methodology. So what does a standard retail trader do when it comes to selling premium? They tend to first premium hunt. So this is looking for things that are really, really high in terms of premiums, which also translates to high IV, which also translates to high HV. This is the downside to this that most of them don't know. The other thing that they tend to do is hold small portfolios. Oh, I'm at the bottom of, I was wondering, I was like, why is this getting so stuck? So they hold small portfolios that are concentrated. So for example, going back to the insurance example, if we look at big insurance companies, Progressive, if you're checking out on Amazon and you get a pair of fucking sneakers, they'll insure the sneakers. If you get a fork, I'm joking here, but they'll insure just about anything that you'll buy now. Just about anything can be insured. Why? It's because by insuring more and more things, you collect more and more premiums so that when this one super expensive Uber mansion in Florida gets flood damage, as that person's policy, even though that policy is still $100,000, if they hold that policy, let's call it for 6 years, so it's $600K, before that the flood happens, and in the flood damage, it's still going to be way more than that. So let's say that the total flood damage is like $2.5 million. The insurance company is still net negative here, and they know it. They want to use this to offset some of this, but then they're going to use the rest of their portfolio to offset the remainder. It's a really delicate system that's built, and it's super fucking smart. Retail traders do not do this. They funnel into super high IV to get a lot of premium, and they get 5 to 10 of those names. What's the problem with that? The problem with that is that they're going to behave as if they're the same thing. So rather than this insurance company that has flood insurance, tornado insurance, fire insurance, car insurance, health insurance, fucking spork insurance, this portfolio has one insurance, high volatility names. That's a problem. Why is that a problem? Because the probability of high volatility names having big moves that might exceed the implied volatility that you sold is pretty good. It's pretty good. So rather than this scenario where this insurance basket has, a handful of really expensive houses or a handful of houses that get hit with flood damage, but then that year there are no mudslides magically in California. So then they just bank all of that and it helps offset their portfolio. This person only has one type of insurance. They're only selling that flood insurance, and then they get wrecked when the flood happens. And then they say, what happened? Why are wrecked? I'm smart, I'm seller, I'm house. You're dumb. That's it. You are just dumb. So let's talk about one other piece to this insurance example that retail traders do an abysmal job at, which is cutting. If you own a house, you have house insurance, and you call your insurance provider and you say, hey, I'd like to file a claim. I had this happen. The insurance provider is going to say, absolutely, we got you, dog. That's what we're here for. Let's take care of you. They'll take care of you. If you have a good insurance provider, a lot of insurance providers will do anything they can to not pay. That's also another angle. The problem with those is that you don't develop a good book of business. Most insurance providers, despite what you're going to see online, most of them will pay as long as you're within the policy. They're literally incentivized to do that because, again, it's a numbers game. They're not trying to not just pay one person, but what they need to do is enforce the policy. It does have to be within the bounds of the policy. Otherwise, their entire pricing scenario no longer applies. It falls apart. The pricing is based on the policy. So one of the things is you call your house insurance and you say, hey guys, need a claim. This happened. Hook a brother up. They say, I got you, big dog. No problem. Cool. You call again 2 weeks later because something else goes wrong. No problem, big dog. I got you. Cool. And maybe you call one more time. because something else happened 6 months down the line. It's just a rough several months for the house. That happens, by the way. Well, at the time for renewal, that house insurance will then write to you and say, hey, it's been awesome. You're rad. What a great person, the greatest person, but we're not going to insure you anymore. And then you're like, whoa, what? Why? And from their lens, they're cutting the loss. That's what that is. It's cutting the loss, which retail traders do not do. They watch the loss get bigger and bigger. They say, I will continue insuring you. I'm just going to roll the insurance out. I'm just going to roll it again and again and again and pretend that this makes sense. The reason why the insurance company is cutting you and they're not covering you anymore is because they've identified a risk. They're saying, this place is having too many problems. This is getting too costly. Based on our models, the probability of this place having more issues is pretty high. So because of that, we're going to cut them. Completely well within their rights. Then people get super upset about it. It's super upsetting because here's the biggest issue I have with that process is they don't tell you. They don't tell you something like, hey, if you have more than 2 claims in a year, they might not cover you anymore, or we might not cover you. That sucks. Why does it suck? It literally happened to me where I had an insurer after a second claim that tried to cut ties, and I had to argue with them in order to maintain coverage. Why? One, it's really hard to get coverage in California because everything is so damn expensive. They have to be really specific with the policy terms. But more importantly, I literally had filed for some stuff just to build continuity, not realizing that it's not about the dollar amount. It's just about the fact that there was a claim. So one of the claims I filed was literally for like $1,000. I couldn't have cared less about the $1,000. I just filed it for continuity for the house. And then I find out at the end of the year, they're like, oh yeah, it was like, too many claims that were open. And I was just like, yo, I'll fucking pay you guys back. I don't care about that. So what I ended up having to do was give them a ton of proof that the things that I had gotten coverage for, I had fixed not just the thing itself, but everything else around it. A lot of military dudes are like that, where like the money that we got from insurance didn't cover the cost of the repairs because the money for the insurance was like a specific thing. But in my mind, it's like fix everything that's even loosely affected to decrease propensity for future, which is good because that's effectively why they reinstated the policy. But they were going to cut the policy to cut their loss. So the overwhelming majority of retail traders do not do any of this, especially that think they're behaving as an insurance company. The problem is people see a credit, meaning you're collecting premium, and then they immediately make a ton of absolutely abysmal mental jumps and confuse themselves into a bunch of things that literally are completely inaccurate. So is it possible for a retail trader to be the house? No, literally never. Is it possible for a retail trader to behave kind of like a quasi insurance, like a really small local insurance company? Sure, that is genuinely much more applicable. Because if you think of some of the really small insurers, they might have only a few hundred clients. So that's much closer to being a better example. So, but those differences are really important because, again, for the naive, they will simply think because I'm selling premium, I am insurance, I have a baked-in edge, and you do not. That's the reality. You have to manufacture it. Just as the market maker, they have structural advantages, but they still have to manufacture their edge. Why? Because if they do not control the risk on their books, they go insolvent. They have to pay in order to secure positions and borrow money to do so. They lose the edge that they had. So the benefit of market makers is they start with an edge. They have an edge, and then it's just theirs to keep. Retail traders, the calculation is slightly different. You do not start with an edge. It's yours to build. The cool part is, as I will always remind people, edge is really not that difficult to build. It's really, really not that difficult to build. There's a lot of sources of edge out there. We spend a ton of time talking about profit mechanisms. That is an edge, and there's a lot of them. The issue that most people have with edge, or the kinds of edge that are accessible to them, is that they don't like them. They want more. They want better risk profiles. Again, a great example for premium sellers. There's a lot of premium sellers that want to hedge the premium they're selling. How funny is that? The relationship there is this. There's an entity that says, don't want this risk. Then there's a retail trader that says, I'll buy. Their bid. They'll take it. But then the same retail trader says, but I also don't want risk. And then they want to hedge their risk. Guess what? There ain't enough edge. There's not enough edge to operate that way. That bothers people because they want to have this edge, and they also want to have some sort of like really controlled risk profile that never makes them feel any type of way, which is the ultimate irony. Because when you're selling premium to behave in this capacity, you're selling premium with the purpose of providing insurance, taking and holding somebody's risk, but then we're simultaneously saying, but I don't really want this risk. And then they naively think, or arrogantly, either or, that they can just go then offset that risk and still make the edge. Like, think of the mental gymnastics that have to go into that decision cycle. If that was possible, guess who would do it? This fucking person. It's almost like a silly pyramid scheme of risk assumption. That makes no sense. It's literally hilarious. All right. That's my monologue. Second monologue for the day. Any questions? Anything that you guys want to talk about in the last few minutes? Let me get caught up on the chat. Nathan says, isn't less so for gamblers, though, and more for supplying institutions with insurance? Not trying to take away from your analogy. My bad. I actually don't remember what that's tied to. Nathan, if you let me know what point I was talking about, happy to discuss that. I have no idea what I was talking about at that point. That's my bad. ZX says, coming from a lot of long-term investing books where dips don't matter, I can't tell how many stocks I've ridden into a hole never to come out, kicking myself for not being smarter. Yeah, the funny thing there is it's not necessarily just being smarter, but it's also being a little more thoughtful with respect to what you're trying to do, right? Because here's a funny example. If you were investing long-term and something dips and doesn't come back, guess what? They still lose money. They lose money too. It's not just like ride through a dip and magically make money just because you're holding through a dip. That's not how it works. So even while you're investing, if something dips and doesn't come back, you still lose. But to your broader point, a really, really big difference is the way that you treat and manage different kinds of market movements based on your overall approach. So for somebody like Buffett, who's more an investor, right? A value investor. That's the heart and soul of what the homie is. For someone like him, if we have a stock, how the fuck would I do this? Literally about to draw a stock price on this when there's literally this. So if we zoom this out just a little bit, for somebody like Buffett, let's say that this is the perceived floor. Just pretend this isn't S&P, pretend this is anything. Let's say that this is the perceived floor. The way that Buffett minimizes his risk is by buying down here. Why? Because if he buys here and then it goes down to the perceived floor, risk is managed. And then if it goes past the perceived floor, we still, in his case, would size it appropriately, that if it hits that level, it's not going to break anything. But the main mechanism that somebody like him is going to manage risk is by getting a really good price. And it's because as we zoom out further and further and further, even if he got in here and then it goes down, he doesn't care, obviously, because he's planning on holding for a decade plus. So this, in effect, doesn't matter at all. This is just a blip on the radar. But this prospect, this entry mechanism is really, really important in that specific methodology's reduction of risk. The problem with applying this kind of methodology to something like options trading is because you also have delta and you also have gamma. Why does that matter? Simple. Let's say that I get an option here with 50 delta and 0.05 gamma. And let's say that it goes down here to where it's now a 10 delta and a 0.003 gamma. The issue that this option has is that while it provides a loss buffer on the way down, right? Because with that 50 delta, stock goes down $1, you lose 50 cents. You're getting 50% of the move. And then as it goes down to a 30 delta, stock goes down $1, you see 30 cents, so on and so forth. So there's a natural buffer built. That buffer has a cost, and it happens during the upside. So now, as the stock goes up $1 during its recovery, you are seeing a tenth of it. You're seeing 10 cents. So as this thing starts making this more parabolic recovery, because, and this is using an example of a long call in case that's not clear, because of these economics and because of the way options behave, you are swimming upstream super fucking hard now. So then as this underlying goes up, let's say 30 points, over that 30 points, let's say you might see 22 cents. Or maybe $2.20 to make it more applicable. Something like that. That's the issue with playing some sort of dip strategy with options. If your timing is that bad, you really need some pretty good severity in order to be ultimately right. Otherwise, you get ripped to shreds. And this is exactly why this is why I'm so reluctant and do everything I can to push traders away from identifying as options traders. Why is that so important? Because if you identify as an options trader, your natural instinct is to only trade options. But it doesn't necessarily always make sense. It's not always the right thing. A great example of this is on the stream Wednesday. I talked to you all about a trade that I made in Russell. I did not make the trade in options. I used a Delta 1 instrument like Russell Futures. I did not want an option. For what I was doing on that intraday stuff, an option would have been suboptimal. What made way more sense was Delta One. So another general point of never be a blank trader, right? Don't be a day trader. Don't be a swing trader. Don't be an options trader. Don't be a futures trader. Just be a fucking trader and do what makes sense. That doesn't mean that you can't specialize. The majority of what I do is options, but it's not all that I do. And I'm very, very thoughtful to make sure that I'm not mentally constraining myself into defaulting into being an options trader, because there are instances where it is suboptimal. All right. Jake says, how do you determine risk? That's actually really, really simple. Like really simple. There's a couple different ways to determine risk. The first important component is to define it. How do you define risk? And that's not meant to be like a condescending question. It's really a nuanced question. And it's because for some people, risk operates as a raw metric. So let's say that I'm a trader, and let's say that as this thing goes down, the most I can lose is $10, just picking a number. In this case, this is my risk, right? This is how much capital I have at risk in this position. And then that could be me deciding if I'm okay with this maximum risk, okay? This is what we would call value at risk. This is for an individual trade, but this can also be done for a portfolio level. How much money can you lose? Value at risk, okay? There are other risk metrics. So let's say that not only do you care about the total risk that you might have, but you also care about the movement sizes, also known as volatility. That's another risk, because that volatility can lead to significant P&L risk. Thor, leave yourself alone, bro. So that P&L risk is another type of risk. So there's a lot of different kinds of risks in individual trade and portfolio levels. To summarize that into something that's really, really simple, at the trade level, think about value at risk. How much money can you lose in this trade based on your management plan? At the portfolio level, we care about value at risk. I care about portfolio Greeks. I care about P&L volatility. I care about kind of baked into P&L volatility, but deserving second bullet is consistency of returns. I also care about max drawdowns. So these are two different lenses that you can think about. And when I'm talking about portfolio Greeks, this also includes things like correlation. So relationships between things, and then the overall metrics for each position then compiled. And then you can do stuff like beta weighting and stuff like that. So this is how I would determine risk. Jake says, like keeping delta neutral or something like that for portfolio Greeks. No. So delta neutrality is another myth that people are sold. It's a complete false bill of goods. Delta neutrality is fake. So people get led down this really negative path of thinking that the way to manage their portfolio is by making sure that they're delta neutral. The problem with delta neutrality is that it's a really superficial take on something that's quite a bit more in depth with respect to things like correlation. Jake says, so Tasty Trade is fibbing. No, they're not fibbing, but I like Tom. I actually have another podcast coming up with Tom soon, but I disagree with a lot of what they do at a practitioner level. However, I understand what they're doing. What Tom is doing is making the world of options accessible to most people. If most people learned about options through somebody like me, they would be overwhelmed and they wouldn't do it. They would just leave. They would say, fuck that. There's too much going on. I can't do that. I'm going to leave. And fair play. I understand that. So what Tasty Trade is doing is they are trying to make things simplified so that most people can reasonably pick them up and do something with them. Now, that's about where our similarities generally end, because I think Tasty Trade misses so much needed context in a lot of the different kinds of blanket rules that they apply, like one of them that you're mentioning here, this idea of delta neutrality. So the issue with delta neutrality is that it's next to impossible to actually maintain something that's delta neutral. And the other thing is that depending on what's on and what the relationships are between those things, the delta can still behave as if there's a positive correlation, even if your delta is showing zero deltas. The individual positions can behave in positive correlation. So it leads people down the wrong path. That said, the broader concept of delta neutrality as he's talking about it is stuff like diversification, having different positions on that do different things. And that's all completely accurate. That's all good stuff. So when it comes to the portfolio level Greeks, more importantly, I care about stuff like what's the velocity of my portfolio that can help me gain some insight in terms of how concentrated is my risk. Am I the theta ganger that thinks I'm being enlightened and smart and selling options and being the house, but the stuff I'm selling is all super high V and concentrated? I can see that through stuff like portfolio level Greeks. The way that I'll see that is my theta will be obnoxiously high compared to the amount of capital that's out. I'll also see things like much higher aggregate volatility across the portfolio. I can see what my aggregate implied volatility is, and that'll be super high. So it's stuff like that. So the world of risk management and trading, especially options trading, gets pretty nuanced pretty fast. And it's because there's a lot that's going on. There's a whole lot that's going on. But yeah, delta neutrality is a completely fine concept. It's something that is not really practical. All right. I'm trying to get caught up on the chat. Okay, so Kirk says the zero DTE strategy that sold 15 deltas and bought 5 delta wings showed positive expectancy over time. How is that different? What you're describing has no edge. Okay, so the issue with that is that it's shown edge in the past. It doesn't carry that edge into perpetuity. So if you followed the zero DTE stuff that I've shared over time, you will see that it's morphed. First straddles, then wide iron condors, then strangles, back to straddles, into strangles. The point is they ebb and flow, they move. So in that instance, there absolutely can be instances where buying a wing makes sense. Just if it's cheap, if it's nominally cheap. But if it's nominally cheap, if it's not, then it doesn't make sense. So the nuance there is what you're seeing as far as positive expectancy is in sample, right? It's in what the strategy saw. Going forward, it very much might not be. And it's important to be able to adapt the strategy so that you can continue to generate profit from it, which is quite difficult. even with something like zero DTEs, where there is a moderate edge, it's very difficult to hold on to it. That's a great question. GME says using covered calls for premium and using to buy more shares in underlying, which doesn't have expiration. Yeah, that's cool. GME says, is timing my use different from timing the markets? No, I don't think so. You could probably time your use better than you can time the markets. Kind of know your body's ebb and flow. That's fair. I get it. Jake says, can you recommend a good book to read? I've learned options, so not the... Hold on. I've learned options for a while, so not the basics. My guess is you probably need the basics more than you think, but a really good book, there's a couple of them that I would recommend to pretty much any options trader. The first one is Options as a Strategic Investment. The next one is Nathan Berg, Volatility and Pricing is a good book. And then pretty much anything from you and Sinclair. So options trading, positional trading, like all of those I think are good. I would say any of those books you're not going to go wrong with. Those are all good. Lauren says, I'm surprised he's a fan of delta neutrality when he talks about how important it is to take risks. Oh, yeah. There's a 0% chance Tom has a delta neutral portfolio. I'll ask him when he comes on to the podcast next. And I literally would bet my left nut that he is not delta neutral. He's very directional in the way that he trades. He just uses short premium frequently in it, but he has like actually very strong directional assumptions. I think Tasty Trade, more broadly as a platform, probably shares that sentiment just because, it does have good concepts wrapped in it. The thing I noticed with Tasty Trade is that there are some things that they really do go into great detail on that provides like good and usable information. The other piece of it is when they're creating these rules of thumb, these simplified heuristics in order to simplify decision making, a lot of times you're throwing the baby out with the bathwater because there is a lot of nuance baked into something like that. So yeah. Anything else? Malik says, diversify your skill set and specialize what you like. Is that the lesson here? Negative. It's definitely not to specialize what you like. The reason why I say that is when it comes to trading, it's again, like there isn't enough edge to just be able to have something that you like and automatically be able to derive edge from that thing that you like. Now, what I would say that's very similar to that, but an important differentiation, is I do think that it's completely reasonable to first, as you mentioned, diversify your skill set. That's super important because in order to be successful as a retail trader, you have to wear a lot of hats. You have to have a diversified skill set. You do not get to be super myopic on anything. Even if you're really myopic in trading an individual industry, you still have to know how markets operate, order execution, risk management, portfolio management. Like you still got to know all of those things. So there is no being like myopic. But more importantly than that in this instance is rather than specializing in what you like, the way that I would think about it is specializing in whatever has edge that makes the most sense to you. Close, but not the same. The reason why that matters is I do think that there's a lot of efficiency to be gained by focusing on things that intuitively make sense, that aren't as big of a leap for your brain to make in order to understand and to appreciate what it is and to do the thing. There are some people that the idea of selling an option is the craziest thing on earth, meaning taking a defined profit and accepting undefined risk. For other people, that's the only way to do it. And either one of those can work. You can choose to predominantly do one thing or the other. The problem is, and what I've found, is being able to objectively move between all of them is much better. You'll perform much better if you don't have those kinds of constraints, those different kinds of mental handicaps on where it's like, I can only do this one thing, or I only buy premium, or I only sell premium. Those are all just literally completely unnecessary handicaps that get placed on to the trader that they don't add value. They just limit the choices you have for really no reason. So yeah, I wouldn't think of it in terms of specializing in what you like. I would think of it in terms of specializing in an edge that intuitively makes sense to you, whatever that edge is. And as I've mentioned before, there's literally tons of them. Super fun session. Great conversation, everybody. It is time for your boy to grab dinner. I'm out. I'll see you all on the Discord. Be an outlier. See y'all later. We out.